Be Wealthy and Smart, episode 1247.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about the fact that U.S. wealth is at a record high. Now, this is not something that's being reported broadly, and frankly, I was surprised to come across this article, but it is from Reuters, and it does say the stock market drove U.S. households to record wealth. While a lot of the media has been harping on recession, the reality is housing prices and stock market values have rebounded strongly, and U.S. wealth is at record highs. This is according to Federal Reserve data that came out September 8th. Household net worth rose 3.7% to $154.28 trillion in the period from April through June, from $148.79 trillion at the end of the first quarter, the Fed said in its quarterly snapshot of the balance sheets of households, businesses, and federal, state, and local governments. The data showed households have fully recouped the wealth losses generated by a crushing bear market for stocks and weaker real estate values through much of last year, as the Fed kicked off an aggressive campaign to rein in inflation through large, rapid-fire interest rate increases. The Standard & Poor's 500 Total Return Index, including reinvested dividends, delivered an 8.7% return in the second quarter, its largest gain since the final 3 months of 2021. The equity market's rally added $2.6 trillion to household net worth, accounting for nearly half of the overall wealth gain in the quarter. Real estate was the other large driver, with property values rising for the first time since the second quarter of 2022, contributing $2.5 trillion to the increase in net worth. Household wealth at the end of June exceeded the previous record high of $152.49 trillion set in the first quarter of 2022 by about $1.8 trillion or 1.2%. The data showed the size of households' cash war chests, comprising a variety of bank deposits and money market mutual fund holdings, continued to dwindle, declining for a record fifth straight quarter to $17.7 trillion. A major contributor to the resilience of consumer spending, that stockpile at the end of June was down by $66 billion from the end of March and had fallen by more than $560 billion from its peak of nearly $18.3 trillion at the end of the first quarter of 2022. Household savings habits continued to shift away from banks, which have been slow to keep up with the Fed's rate hikes by offering higher interest rates on checking and savings accounts, and until recently, certificates of deposit. Bank deposits fell by more than $200 billion to below $14.2 trillion, while money market fund balances climbed by $137 billion to a record of more than $3.5 trillion. Debt levels for households, businesses, and governments kept rising in the second quarter, though the pace of increase varied widely by sector. Total non-financial debt increased at an annualized rate of 6.3%, the fastest since the first quarter of 2021, to $71.2 trillion, with households and businesses each accounting for roughly $20 trillion and government $31.3 trillion. The main driver of the increase was the 12.7% annualized increase in federal government debt, the largest since the record increase in the second quarter of 2020 that had fueled the first round of pandemic relief spending. The U.S. Treasury ramped up bond issuance late in the second quarter after the Biden administration and Congress struck a deal to suspend the federal debt ceiling and avoid a government default. Business debt growth, meanwhile, moderated substantially, climbing at just a 1.9% annualized rate in the second quarter, its slowest growth since the final 3 months of 2020. End of article. I think the thing that really surprised me the most was the fact that real estate and the stock market values have rebounded for U.S. households, but that really hasn't been reported. At least I haven't been hearing that. And quite the opposite impression has been given through the media. And I think ultimately what's going to happen is we'll find out that we lived through a recession and it's already over and things are already better. And I still think that interest rates will start to come down because of the lag effect. When the Fed raises interest rates so quickly, it does take time for it to pare down the inflation. But I do think lower inflation numbers will start appearing, and that will make the Fed take back some of their rate hikes eventually into next year. This is going to kick off not only a big stock market rally when the market realizes the Fed is not only done raising rates, but they're going to be easing rates into the future, but also it's going to kick off a huge boom in the housing market. As interest rates decline, people are going to be out shopping for homes again. And yet I do think here in mid-September, we could go to new highs and then have a sharp dip in October that's going to be sharp and scary. But from there, really start rallying hard with rates coming down and the stock market taking off, the IPO market being robust, real estate being strong into the first half of next year. So even if we get a scare in October, I think it's just going to be just that, a scare. But from there, you've got year-end window dressing, you've got investment firms that are not invested in the market, they've been short this market, they're going to need to buy back stocks, cover their positions, and also get fully invested so that at the year-end report, when investors look at it, it's going to show that they're fully invested in all the winners of the market for the end of the year reports. So I would take any dip as a buying opportunity, because that one that we have possibly coming up in October might be the last one before the market really starts to take off. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my podcasts are on my website at lindapjones.com/podcasts. And while you're there, sign up for my weekly newsletter for more wealth tips. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.